Do you think SoFi pumps on earnings, or how do you
Yes.
think this
Yes.
quarter? So do you think they reverse the trend from the past 7 quarters and they actually go up on earnings this time?
Yes.
There's no 7-quarter trend. Okay, they go up on earnings sometimes.
No, there is a 7. What are you talking about? Every quarter they go up a
Show me.
little bit, and if you just look at the chart, every earnings they go up a little bit in the pre-market and then they tank. Now they recover quickly, but still.
I forget what it is, but if you look there, I think maybe Seeking Alpha does this. One of these data aggregators does it, where it shows you what the price of the company did 1 day and 7 days after reporting earnings. It's a lot red for SoFi, but there are green moments. It's not a 7.
Well, at least the most recent quarters have been pretty bad in terms of.
Yeah, there's one I think out of like 6 or 7 that is different, but all the rest have been that pattern. So I think that there's 2 things different, more than 2 things, but like 2 big things. So one is the macro. Usually heading into earnings, we have weakness. At least this has been the 5th earnings in a row that's been the case, not for SoFi, but for the entire market. There's, the wall of worry that happens. Some legitimate, some, I think are just silly. And I think usually, earnings is uncertain and things have been climbing a lot. So I think part of it is people taking money off the table and maybe having some hedges. And then as we get usually at the midpoint of earnings season, then that reverts. Now, I think we are actually past the reversion. I think that we had that pullback that was healthy a little bit earlier. And then when a couple of things happened, but including banks just posted phenomenal numbers. And there's, we had, CPI, PCE, PCI, all report at the same time. Jobs numbers look good. It's tough to see a concern other than just like, well, the multiples have expanded a little bit. So I'm guessing, unless there's just a lot of like really bad earnings and guidance, and it's hard to see that with the corporate income tax rate being reduced, even with the dollar index being a little bit higher for international companies. So I think that was the dip, and now we're just off to the races again until typically maybe March or April we'll see a pullback. It's the sell in May and go away. It usually happens a little bit earlier these days, it seems like. And I'm not planning to sell in May, but no, I think we'll get another one of these before the next earnings, and it'll keep doing this for a little while. But yeah, for SoFi itself, so we have the macro, and the fact that I think that the dip for the market is kind of over. And the other piece is they've been profitable for an entire year at this point. So there were some bears, including one that Tanner interviewed, nice guy, but just completely wrong. Who insisted that SoFi was unprofitable because they hadn't put up a full year of profit yet. It's a silly way, and it's an old-fashioned way to look at a company, and it's a lagging indicator too. But that's the way some of the people in the market look like. And so when they see those 2 things, plus all the things that SoFi is building, the loan platform, the acceleration and growth, for the most part, there are some harder year-over-year comps, but I mean, it's pretty clear SoFi is phenomenally positioned. The macro is favorable, not just for the stock market, but also for lending companies. And banks killed it. Like, look what banks did and what they said on loans. Like, they killed it. I should do a video on that sometime.
The thing is like, what's this showing?
What?
Just the prices? There's not a comparison between the two or something?
No. Yeah, the overnight price.
Okay. The only thing that I would add as well is for SoFi, last year we got killed in Q4 of 2023 because they had to be extremely bearish for 2024 outlook because the overall macro was poor. Okay, or at least it was guided to be very poor. They had something like 5% unemployment, a 2.5% decline in GDP, like just crazy outlooks for the company. But then last quarter, Anthony Noto said this is the best macro they've seen for their company in 7 years. How can they possibly come out with a poor quarter with the same rhetoric? Now, it's a little bit different. We went from 100 basis point cuts expected to 50 basis point cuts. So I hope that doesn't weigh heavily on their guide for 2025, but it's all about the guide. Okay. It's all about the guide. SoFi is going to crush the quarter. Everyone knows this, but what do they expect for 2025?
So here's my question. If the tech platform doesn't grow a ton, is the loan platform where you guys, the financial services growth is going to come from?
Dude, it's crazy how big the loan platform business is. Like, I hope you're giving it the respect that it needs to have.
I'm actually not, and I need to be educated. So can you give me the quick TLDR, both of you, on what is this thing? Like, I know it at a high level, but why is it something everyone should be excited for?
Usually a bank has to give out money based on how much money that they have. But now SoFi is giving out money based on their institutional clients, how much they have. So it essentially gives them an unlimited size of a balance sheet to then lend out to. So they're no longer constrained to total addressable markets. There's no point in calling them a bank because their price to tangible book value means zip. Okay. They can essentially give out as much as they have in members or as much as their bank partners have in capital themselves. So this is why Upstart has such a massive valuation, because they're using other people's money. Well, essentially, without acquiring them, SoFi has just created an Upstart. And so, yeah, when
did this all happen? When did this randomly become
Q3? We had no idea it was happening during Q2. And then all of a sudden, bang, $40 million. Sorry, no, it was more like $63 million additional quarter. And then they said the run rate for next year is something like $400 million new dollars for next year, out of nowhere.
And they've announced a couple of one very large through Fortress $1 billion loan securitization, another $235 million, something like that, fairly recently as well this year. There's massive appetite for them, and I was going to throw out that Upstart name. I don't like Upstart at all. As a business, it's won't talk about them too much, but Upstart claims, with their algorithm, with their AI, that they are able to lend in a better way than just the FICO scores indicate. SoFi has time and time again proven that they are incredibly effective lenders, that their write-offs and delinquencies are lower than all the analysts typically expect. That's one of the reasons why they've been bearish on SoFi, is they've been worried about capital constraints. This was an argument from a year ago where they're like, hey, they're pretty near there. They'll have to get a whole lot more assets or sell some loans or something. That's no longer a worry. Second, like they're just absolutely killing it on this front. So they didn't have to acquire anyone. They're just like, hey, we have this ready to go. So that's huge. Now, the tech platform itself, I do have some concerns with it, but with FinTech winter shifting to FinTech spring, that only benefits them. Like we even talked about it. If Robinhood goes the route of some sort of product that they need a cyber banking core without the charter, that's Galileo. There are a couple other providers out there too that maybe they'll go with instead, but Galileo, I think, really is best in class on that front. So I think that's pretty massive.
I have two questions. What is there risk to this loan platform?
Zero.
How's there zero risk?
Because we don't assume any risk. It's the clients that are taking it on.
Yep.
So unlike Upstart, which will share risk, with the institution, SoFi shares zero risk, and they only ever buy the loan after they've already received your money. So there's not even there's no.
How do they get away with that? How do they get away with zero risk?
It's not their loan. They're buying a loan for someone else immediately. They never hold it on their balance sheet.
So not
for a day.
You've not done mortgages yet, but mortgage is an example. Like typically, so when we bought this house, we got a mortgage, and I don't even remember the company it was with, but we had that. They held that loan for 30 days or 60 days or something. Then they sold it to Wells Fargo. So Wells Fargo gives them a percentage of the cut, and so once that transaction part is done, they no longer have any risk. Now with SoFi's product, they're not holding these for even a second. All they're doing is basically sort of vetting the person and just saying, okay, they check out, they're good to go, and they're your client. Here you go. Thank you for your money, and hope it works out for you. If it doesn't, well, that's
so. This is like a referral fee. They're a middleman with this loan platform.
So what's so funny is before Q3, they were doing a referral program and going to companies like Pagaya and saying, here is a client that might be willing to look for a loan. Okay, you guys can take his application and do what you want with it. But now what they're doing is saying, hey, we have a client. We've underwritten him. We're using our proprietary software, our AI, and he's a very, very good borrower. Do you want him? So what's so cool, this is the interesting part of it, is that how does Upstart grow? How did they get these 300% quarter over quarter growth rates that got the market to have these analysts coming on just covering the company without knowing it? And it was the hottest stock in the market. It's because they used, whenever you are using automated AI tools to underwrite people, the only expense that they needed to worry about was sales and marketing to get more people onto the platform to recycle the whole business. Okay.
Right.
SoFi is even better than that. They are now going to have this tool that they can get clients immediately onto the platform to sell loans out without having to cycle their balance sheet at all. But when they're on the platform, they never leave SoFi. So if we're looking, you're going to start seeing only advertisements for SoFi that say personal loans, home loans, student loans. And they're going to get these people who are really hot leads, which are very expensive, advertising customers that need loans right now. But we're going to immediately cover the costs because they're going to be paid for before we even sign those clients up. And then they're already on here. Do you want a credit card? Do you want a checking account? Those are free for SoFi. So unlike Upstart that can only get customers for loans, SoFi has them for the rest of their product suite for free. It's insane how differentiated the loan platform business made SoFi. It literally changed the business model. It's going to change. It literally changed the way institutions valued them. It's why the stock doubled. It went from $8 to $16 because of this change.
And this isn't SoFi Weekly, but look what analysts are expecting for EPS this coming year. Compare it when the guidance comes out for SoFi. They're going to be wildly different. It's not going to be close. Now, tech platform, I have some concerns, but they have a lot of tailwinds on it. So, but even without that, like my base case for SoFi is tech platform goes nowhere this year, which I don't think is going to be the case. But if it does, my base case for SoFi is it gets to 25.
What is the potential? Are you worried at all that there's a lack of moat on this loan platform, that the middleman gets cut out, or not really an issue?
No, that's where all the moat lies.
There's so much demand, and I mean, their success as far as delinquency rates and write-offs, like just write-offs is the wrong term, using credit cards. But they speak for themselves. I mean, it just and they show like the loan vintage slide, like that's one of those key slides to really understand SoFi and its success. This isn't just a fluke. This isn't just a one quarter thing. They have quarter after quarter after quarter demonstrated superiority in this area, and at some point, eventually the market will just start maybe they don't, but they should just say, okay, it's been, like years of them outperforming and years of their guidance and outperforming that. Maybe we should just give them a little bit of credit, and they haven't yet. So there's a lot of upside there. So
is this their AIP moment, Roy? You think so?
I mean, no, that would be the tech platform if that really takes off. But I mean, for me, like, here's where I am with SoFi. This is going to be an amazing year. I have a lot of options. I have a good number of shares too. My options are actually, because of I bought most of them when it was $6 and $7. They're much larger than my actual shares. If the tech platform accelerates like I think it could, I'm about 60, 65% sure that it will. So that's not super confident. Then there's a lot more upside beyond that. A lot of high revenue, a lot of growth. And the macro shifted so that it should perform very, very well this year. I don't think this quarter will be the quarter. I think that we'll start to see that upswing really all the way through the year. This feels like the 13% year-over-year growth for Palantir as far as like the tech platform moment, where it just keeps going up. And Tanner and Tevis are telling me, oh, it's growing this slow. I'm like, dude, what matters is the trajectory. This matters a lot, especially for this kind of business-to-business client in this tech industry. So I think that we see that. And if that's the case, then I'm not going to sell all those. Looks like we'll sell some, but I'm just going to use that and get some $10 shares in 2026 or 2027.
Eric in the chat said, no, this is their boot camp moment. What I would actually say is that this is their AIP moment. What Roy is saying, the Galileo part, will be their boot camp moment. where they have the product, which is the loan platform business, and learning how to sell it will be through all of their Galileo clients. Because right now they're here for card programs. But who's to say, hey, you guys want to get into loans? All right, bring their applications to us. We'll underwrite them and sell them back to you. That is where I think that their actual boot camp moment happens. And then their customers expand tenfold. That's the real end game here. Which is what's crazy is if you go back to the 2001 investor presentations with SoFi, Anthony Noto was talking about this product back then. Like, this is not something that they've had in their mind. The only reason why they didn't want to push out more referral-based products earlier is because they got a banking license and they needed to build a balance sheet over the last 2 years. So it took a pause. But now they have a full balance sheet. They're not looking to grow it. They have it. And they are going to now build externally.
All right. Well,
we'll have to see. We've got a weekly show to cover just this.
Yeah. Well, I hope SoFi earnings reverses the trend because I think they're a good company. They deserve it. They just have to have that moment where the street's like, all right, it's time to stop treating them the way we treated them.